Hey, what's up, guys? My name is Cody Charnell. I'm a multifamily real estate broker here in Long Beach. And today we're going to be looking at a recently closed sale here in Long Beach. This is an example of a value add deal, and I want to bring this to you to show you what's happening in the market today. A little disclosure, I was not involved in this deal. This is really just an example for you to keep you up to date on what's happening in our local multifamily market. So without further ado, let's get into it. Okay, so let's start with the map view. So this is the property right here. And if we zoom in, what we can see is it's actually two separate properties. So this sale consisted of two 4-unit buildings that were right next door to one another. They're identical buildings, and we'll get into the details on those in just a little bit. But location-wise, these are located in a neighborhood called Lincoln. The neighborhood gets its name from Lincoln Elementary right here. Borders Cambodia Town and the Hellman District in North Alamitos Beach. And major cross streets, you're right on 10th Street and close to Alamitos. So really 10 blocks to the ocean here. You're not far from downtown Long Beach. You're not far from the Blue Line, or actually the Metro Line, which runs up and down Long Beach Boulevard. So really not a bad location at all. So this is going to be one of the most affordable neighborhoods in Long Beach. So really high demand for these types of rentals. As we're looking at these on Google Street View, you can see they're really identical buildings. Each building consists of 4 units, and all 8 of the units are 3-bed, 1-bath. And this is something I would consider a value add deal because rents are about 60% below market price. If we look at this from overhead, you can see there's a lot of parking in the back. The total lot space is going to be just under 15,000 square feet. Both of these buildings are 1977 construction. They come with little covered parking in the back, and each unit is going to be over 1,000 square feet. So in this neighborhood, 3-bed, 1-bath units are renting for about $2,700 a month. All the units are separately metered for gas and electricity, so the owner doesn't have to worry about those expenses. Probably my favorite thing about these deals is the fact that it's 2 separate parcels, but they're right next door to each other. So it gives you a ton of options for financing. So someone could either purchase these with commercial financing. So this is financing that you'd get on 5-unit and up properties. They'll look at the buildings more as a business rather than the borrower and the borrower's ability to pay the loan and afford the loan. Or you can buy these with 2 separate residential loans. Those types of loans, it doesn't matter what the rents are when you purchase. So when you're buying in the 5-unit and up space, especially value add deals, the commercial financing can be kind of a double-edged sword because the bank wants you to put down enough to make the property's cash flow immediately. So a building with really low rents isn't going to support a very big mortgage. So most of the time when investors are looking at value add deals in the 5-unit and up space, they're typically having to either purchase all cash or purchase with a bridge loan, which is a high interest rate, short-term loan, just to allow someone to buy the building with good leverage. So you can put 25% down with the bridge loan, fix up the building as fast as you can, and then refinance into conventional financing, which is longer term, lower interest rate, and will allow you to pull some of your money back out after you've gone in and renovated, raised rents, and added value. So because there's 2 separate parcels here, and you can buy this with residential financing, it opens up another option for you. So residential financing, the lender doesn't care how much money the building brings in rent. As long as you, the borrower, have a strong enough debt to income ratio to support the loan, they'll let you put 25% down and purchase a 4-unit building. So you can buy these with 25% down residential financing at around 6.875%, which is a lot better than the 11% that a bridge lender is going to charge you. And you can take your time fixing them up. Once they're fixed up, you have the option of either refinancing into residential loans again, or you can refinance into one commercial loan that'll basically blanket up across both properties. The other thing that I love about this deal is how much space there is. So because there's so much space at the back of the lot. And because this is a multifamily, these are both multifamily properties, you can add up to 2 ADUs per parcel. So you can take these from 2 4-unit buildings to 2 6-unit buildings, which adds significant value. So enough about the buildings. Let's take a look at the numbers. Okay, so a little bit more about how this sale went down. So this property was listed mid-March. It was only on the market for 4 days before they had over 10 offers. It was originally listed, or each property was originally listed for just under $1 million. So total purchase price for both, or asking price for both, was about 2 million. So within 4 days, they had an offer for both properties for over 200,000 over asking price. And they went into contract mid-March and they just closed mid-April. So it looks like it was just under a 30-day escrow. So I'm guessing that this buyer probably used residential financing to purchase these. They may have also used a bridge loan, but we'll have to wait until the tax records get updated to find out for sure. So the way I did my numbers here, so I did this as if they did 25% down payment, which would be accurate for either a bridge loan or residential financing. My interest rate is going to be residential financing. So this is going to be a fully amortized loan, so not interest only, at about 6.875%. Our current rents here. So each of these 4-unit buildings actually had a unit that was in eviction. So for those 2 units, I put in market rent. So for a 3-bed, 1-bath unit in this neighborhood, like I mentioned, 2,700 is about right for market rent. So for the rest of these units, we have 1,100, 1,450, another one at 1,100, 1,350, 1,875, and 1,250. So rents are pretty far below market. So what I'm expecting is that the new owner is probably going to either offer cash for keys so that these tenants can move out. They may rehab these vacant units and offer those to some of the existing tenants at market rate and see if they want to move into the renovated unit, and then the new owner can go and update the unit that they moved out of. Or a new owner could use substantial renovations. So the substantial renovations rule comes from AB 1482. That's the statewide rent control law. It says that if you're substantially updating the major mechanical, structural, or you're abating some type of a hazardous material, and it's going to take at least 30 days and make the unit uninhabitable, you can vacate that and ask the tenant to leave. You do pay a relocation assistance amount of a minimum of $4,500 in Long Beach. I'm also including a renovation budget here. So I'm including $30,000 per unit for all 8 of these. And that should be enough to upgrade them really nicely so you can achieve market rents. So on the right here, I have market rents for all the units at $2,700 a month. So you're taking your rents from a total of about $13,500 when you purchase it up to $21,600 once it's all done. And keep in mind, this doesn't include the ADUs, which would be a lot more to build, but you're also adding a significant amount of additional income. So that would take you to an even higher level after this. And what we're going to look at also is the stabilized value. So I'm projecting very conservatively that the new owner is going to get a value based on their new income of at least 12.5 times gross. For a 5-unit and up building, that's probably about the right gross rent multiplier to use. But for a 2 to 4-unit building, I think you can do better than that. If the new owner was to resell these as 4 units, I would bet that they would sell closer to 13 times gross, maybe even higher if they're nicely redone. Okay, so this is the summary tab. What we can see is based on the current income, they bought this property at about 13.5 times gross, which is an amazing price for a value add deal. They're going to be able to stabilize this building at 8.5 times gross, which is very rare to find. And that works out to about a 4.5 cap based on current rents and about an 8.3% cap rate once they're at market rents. So you can see here what the cash flow looks like. So they're going to be negative right off the bat. So they're going to want to vacate these units and get rents up as quickly as they can. Once they're up at market rents, though, they're going to be cash flowing about $53,000 per month or per year. And we can see down here what our stabilized value looks like. So once they're bringing in that 21,000 per month or about 260,000 per year, that equates to an exit value or a stabilized value of about $3.2 million. So that's about 1.6 per property. And that's over $1 million in upside on these buildings. So these types of deals pop up occasionally in Long Beach. And when they do, it's very competitive to get them. So I'd love to hear what you think about this property. In the comments, let me know if you would be interested in a deal like this. You can also check the info below. I'm going to link to my email list where you can subscribe. So when these deals hit the market, I always send them out to my database immediately. And thanks so much for watching. Make sure to like and subscribe if you like this video. I'm going to be putting out a daily property analysis like this. So if there's any other properties you'd like me to analyze, feel free to shoot them my way. And remember, invest well, trust Cody Charnell.